Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamond Show with John Cohen on real estate financial planning and large multifamily properties. I'm Dan Breslin, host of the REI Diamond Show, and each week I invite another high-caliber performer to share their unique experience as it relates to real estate investing. This week's guest is John Cohen, president of JC Property Group, Incorporated. After getting started with tax deeds and tax liens in 2010, John transitioned his focus to the multifamily asset class and closed more than $70 million worth of transactions in 2014 alone. In his past life, John was a licensed stockbroker, but decided that brick-and-mortar investments were far less speculative. He also played baseball for Queens College while earning a degree in economics. So John is about to share with us his very unique perspective on real estate investing. Welcome to the show, John.
Thanks, Dan. Thanks for having me.
So the big burning question, you have made a tremendous stride in the 2010, 5 or 6 years or so since you got started in the business. Why don't you give us the 5-minute Reader's Digest version as to how you got started with that and kind of how you got to the place where you are and what your business looks like currently.
So basically my background was I graduated college in 2009. After college, I played baseball. My mom basically said, you got to get a job or, get out, figure it out. So the easiest choice for me was get a job from Long Island, New York. Traditional route for me, she said, here, I found this ad in the newspaper, give it a call. So I called it up, went for an interview. I was a stockbroker. It was a classic move for someone from, where I am. I had a couple friends that were doing it. So I went in for the interview, and when you're 21 years old, you think it's the best job in the world. Signed up, did what I had to do, got licensed as a Series 7, Series 63 stockbroker, and did that for about 3 years. Through that period of time, I ended up working my way up to getting a job interview at Morgan Stanley. Went through that process. It was about 13 interviews and callbacks and ended up getting hired at Morgan Stanley right around the Facebook IPO time. And after I got the job, I walked in the next day, walked to the manager, the guy that was in charge of the program that I was accepted to, and quit. The day after I got the job, and he basically said, you're kidding me. You're the youngest guy in the office by 10 years. What are you doing? And I was like, no offense, but I can't see myself doing this for the next 50 years or the next, 25, 50 years. So I quit, called my mom, said, Mom, I quit. She said, are you crazy? I said, maybe, but I think I'm going to do real estate. And that was like, well, now I know you're crazy. What are you going to do? And I was like, well, I'm not going to be an agent or a broker. I'm actually going to be an investor. And then she just hung up the phone and said, then I saw her later that night, and she's like, you really have gone off the deep end. I support you 100%, but you're a little nuts. From that period, from the 3 years of work, saved up some money, started doing a lot of research, wanted to find a cheaper way to get into real estate because I didn't want to spend all my money and not have anything left. So I came across tax deeds and ended up buying a couple tax deed properties. In the beginning, they failed, but it was $350 tax deed that I bought. So no harm, no foul for the most part, except the best part about it gave me the education on what not to do. And I sort of taught myself. Through that period in the early stages of real estate investing, I realized that you don't make too much money too quickly. So I ended up getting my license, becoming an agent, becoming a broker, and started doing rentals and sales in the city while investing in tax deeds on the side as well. And then graduated into the commercial side of it, got hired at Marcus & Millichap, and started selling multifamily properties in Bushwick, Bed-Stuy, and Ridgewood. And then from there, I met a good buddy of mine, actually a family friend, more or less like an uncle, who asked me what I've been up to. I told him, said I just put my first offer on a 44 unit. He said, you got to meet my buddy, and met him, spoke to him, ended up realizing that he was the person that I needed on my side to get my business to where I wanted to go. And I finally bit the bullet, sought the advice that I needed, paid for some coaching, and realized that that's exactly what I needed to do to bring my business to where I wanted to go. He helped me tailor, and I give him, there's not a dollar value I could put on what he did for me, because he took my small tax deed business, occasional wholesale, fix and flip, and he took it from that in about 12 months. I went from nothing buying $15,000, $20,000 houses in Philadelphia to, in the last let's just call it 12 months, closing on 152 units, have 299 units in contract scheduled to close in March, total value of about $22.8 million in value, and in 6 total deals in the last 12 months. So that was the quick, basically, horizon over the last 5 to 7 years of my real estate career.
Nice. That is a leapfrog story. We don't get to hear that too often in such a short amount of time. Congratulations on that success you've achieved so far, John.
I appreciate that. Like I said, I give credit to the people I know and the team that I built around me to help me get to that part. I appreciate the compliment.
So let me ask you this question. 3 years as a stockbroker, do you think, looking back, that was somewhat foundational, maybe just seeing the large amounts of money coming in and out of accounts, or being around people at Morgan Stanley who are, high-income earners and already doing things of these higher dollars? Obviously, a Facebook IPO is like some phenomenal amount of money that transpires in a deal like that. Do you think, your opportunity to witness those kind of transactions back in those first 3 years is part of like what made it so easy for you to transition to just 5 years, not even 5 years later, 22 some odd million dollars worth in closings scheduled and waiting to happen? Do you think that foundation helped?
Absolutely. I tell people all the time, people that work for me, some people that I'm working with, that the 3 years I was a stockbroker, it was the best sales training that you could possibly have, because it basically eliminates all the fear in anything you're going to do going forward. I was making about 500 calls a day trying to raise money and pitch stocks, so you get rejected a lot. And that rejection made it an easy segue or path, and seeing what those people were doing and wanting to be like them, just not believing in what I was selling was difficult, because it was a necessary evil. You had to do it to make money, but I didn't believe it. So the answer to the question is 100%. It was amazing training. It really taught you what to look for, how to do it. The flip side, while I was doing that, starting to read up on real estate, I actually spoke with my dad, who's a CPA and an attorney, and I said, Dad, I have a great idea. Why can't I be a stockbroker, but instead of selling stocks, why don't I cold call and raise money to put them into tax deed? And he said, that's a great idea, John, but it's 100% illegal because you have a ton of laws you're breaking. Blue sky, SEC, you can't do it. And I was like, oh, okay, there's my billion-dollar idea, shattered. So I said, well, what happens if I just go out and do it on my own and sort of tell people? And he's like, well, now that's a different story. So I think the training that I got there and the experience I got there and the people I got to deal with on a day-to-day basis, raising money, having a book of business that I did, it was easy for me to, do the transition, but do it on my own, where I felt confident enough to go out and start talking to people and networking that I knew what I was doing. So, yes, I think, I couldn't be happier that I went down that path at first.
If we could just touch on it, did you reach a level of success with the tax liens and tax deeds where you began making a profit? You mentioned the first deal or two, you lost money, but did you have a level of success in that niche, John?
Absolutely. I mean, to date, my buddy keeps saying, he's like, you're a glutton for punishment, because I still buy probably, let's just call it, maybe 15, 20 properties in Philadelphia a year, because I know it. It's back of my hand. I know the properties I buy, what I'm getting myself into. And it's my way of, I'll use this word loosely, but gambling. I'm not a big gambler, but for me to take a couple bucks and, mess around and go buy 3 or 4 properties, I know real estate. So I'm not, like I said, gambling loosely, but, you open some of these tax deed properties and they're rough. And it's my way of continuing to do it. So, yeah, the answer to the question is yes. I did eventually get success. It took a couple of years to get to, so I was not making, you make $1,000 when you're 23 years old, and you're like, I just did $1,000 real estate transaction, but you don't realize that you put in, 2,000 hours, and it was not worth a nickel. But, you're not thinking like that because you're getting your footing under you. But, yeah, I have, I've done probably about 100 tax sale transactions, and recently, over the last 3-4 years, they've definitely shown value. I mean, I bought a property at auction for $28,000, and at the end of the auction, I actually ended up selling it for $40,000 to another guy in the audience who just didn't have the money at the auction to pay. So I bought it, sold it to him, and we ended up going to the bank. He got me a check and split it. So there was success, but it definitely, the time that put in the early part ended up correlating on the back end, and that's why I still do it to date, just to, keep it going. And the multifamily deals, they take some time. I've done 6 deals in the last going on 12 months at the end of March, but it takes some time to put them together. So in the interim, I do still like to buy some properties in the Philadelphia area, one area in particular, just to keep it going and, keep myself out of trouble.
What area is that?
Oh, down in Philly? In
Yes.
West Philly for the most part.
Okay. You had this paradigm shift. You were doing tax deeds and you're running around. And I know because I did the same thing in Philadelphia. I'm looking at, the list for the sale that's coming up, and there's 40, 50 properties, and we spend 3 days straight driving around trying to get a feel for which properties to bid on. And I found easier, more effective ways to make money myself in my own business than to do that. So you had this transition, this shift. Was this partially as a result of the relationship and the coaching that you had? Was that to now focus strictly on the multifamily stuff? I mean, what brought about that change, if you could kind of dissect that?
Absolutely. Excellent question, because I think it's a question that a lot of newer investors, even experienced investors, come to this crossroad at some point. And I was a multifamily broker working for Marcus & Millichap, selling multifamily buildings. While I was still going out and buying tax deeds, I did a fix and flip out here by me. And my uncle, a very good family friend like an uncle, basically said, I was working with his son and his nephew trying to help them get their footing under them for real estate deals. He's like, I really appreciate what you're doing. What have you been up to? And I said, well, actually, I just put my first offer on a 44 unit. And that's when he said, you got to meet my buddy. And to the question's point, I sat down with him, and my vision of my company was not 100 tax deeds over 3 years, 30 deals a year. I wanted to go bigger. Part of the reason why I went from a residential agent to a commercial agent. And when I spoke with him, he said, when I started, he had, and his name is Chris Urso. He's a multifamily guy now, and he's like I said, I could not credit him enough. He was doing fix and flips and rehabs and rentals on smaller deals in about, I think it was 3 or 4 markets throughout the country. And he had an advisor at the time, and he sat down with him and he said, I want to own a $100 million company. So his advisor actually took out a pen and said, write this down, and wrote down some numbers. And he said, oh my God, I'm going to have to buy a lot more properties. And I was coming to the same crossroads. Part of the reason why I wanted to get into the multifamily side, I saw what my clients were doing, buying and selling at Marcus. And I spoke to him and I told him, I said, my vision is big. I want $1 billion company. I want to go as big as I can. And he basically said, you're working with us because I can't let you. I'm excited to work with you because of your passion. It was the missing link. It was a push that I needed to get, myself off, for lack of a better term, get my ass up and go. And he was the missing link that basically said, listen, I'll teach everything you have to know, but I can only give you the tools. I can't build your house. And speaking with him, I saw the vision and said, this is the business that I wanted to do when I left being a broker, a stockbroker, raising private money, finding deals, putting it together, and going out and doing bigger deals. So he sort of was the one that said, I could help you get there. To the question's point again, yes, without him, I'd probably am I saying I couldn't make this transition? No, but the learning curve would have been tremendous. And if you buy a 50-unit building and you lose $150,000, that could basically cripple your career. And next thing you know, you're back doing a 9-to-5 job, working for somebody else. So the cost that I, got for the education took out the learning curve and was able to get me to where I wanted to go a lot quicker. And it really painted that vision in my head that I could see and I can go get faster than if I would have just figured it out on my own. So, yeah, I contribute 100% of my success now to my buddy Chris.
Nice. So JC Property Group Incorporated is now focused on buying. Let's talk about the focus of the business today, kind of the business model. What are you looking for? Why are you buying these assets that are currently under contract and waiting to settle? And what's your plan? Are you keeping them long term? Are you going to sell these properties? Kind of give us an idea of the timeline of the deal and the vision.
So JC Property Group right now, yes, 100% sole focus is on the multifamily asset class. And the type of properties that we look for, 100, 150 units or more in a B and C location, which is property style, class, vintage, that, in an area that is not downtown Manhattan because the prices are crazy. So we look for that B and C type of property. It also allows for the most renters. You know, my perfect renter is a very solid blue-collar class demographic. They're always in need of housing. That's why I like the multifamily class as opposed to office space, retail, industrial. You know, those properties are great in their own terms, but for long-term security, people always need a place to live. That's why I pick multifamily. I'm looking for properties generally $5 million or more is really the benchmark on price. I like 1980s or later, but sometimes you got to go a little bit earlier vintage. But each deal is deal by deal specific as far as how long I hold. I like a value add component. It's something that I really look for, whether it's, it could be mismanagement, lack of capital, down units, deferred maintenance, horrible exterior, just need some love. But I do like a value add component to the deal where I can go in and bring my expertise and my team to fix it up, get it better, reposition it. In that case, those deals tend to be a little bit more short term because you can get in there, fix them up, do what you got to do. On the older properties, you want to get in, do what you got to do, and we're talking about 24 to 36-month holding periods. And then there are some deals, 2 deals that I have in contract now, that have a value-add component to them, but they are perfect properties. One's 2005 built, and one is 70s built, but in very good condition. Those deals will probably be 7 to 10-year deals because of where the assets are located in their location. Long-term, I love them, whereas some assets are in not as good a location, and those will be more for, the 12 to 36-month time frame. So each deal is a little deal-by-deal specific, but for the most part, we're looking at 24 to 36 months or 5-year holds and 10-year holds, depending on what kind of deal they are, in layman's terms.
Got it. So 5-year, 10-year. What would be the driving 3 factors that you would hold a property for 10 years? Just like the example you shared, what would be the 3 top reasons why that's a 10-year and not a 5-year hold?
I would say location, market fundamentals, and quality of asset. I don't want to buy a 1970s property that's going to need roofs in 7 years that has a lot of deferred maintenance because the heavy lifting is not going to stop. Whereas, one of the properties I'm buying in Charleston is 2005 built, excellent location, great market, and it's a good demographic. I'm not saying anything bad about A tenants, B tenants, C tenants, and D tenants. But as you go down that order, as you go down that chain, you just got to have a little bit of a tougher skin to deal with that on a long-term basis. So I would say, the top 3 reasons is, asset class, location, market fundamentals, and the tenants that live there. You don't want to be, tenants beating up your property and you having to do pretty heavy turns every single time. Because as your business grows, you don't want to lose focus on one of your assets. If you're going to go do a $20 million deal and you have a $2 million property still under management, you don't want to lose focus on that by saying, it's not worth anything to me because you still have investors in that deal. So you can't lose focus. So those deals tend to have a shorter term as opposed to the longer deals, which are going to be less management intensive, where you could sort of, really give, the property manager's on the property and you're managing the manager, but that property is a little bit easier to manage, so it's not a time suck as a lower class of property. Long term,
You're basically flipping apartment complexes over the course of a long time, and I guess there's distributing the money and cashing the investors out. And we'll talk about the money raising mechanism and component of your business in a few minutes. But first, I'd kind of like to know the trajectory because you mentioned, hey, I'm buying this $2 million property and it's a 12-month thing, and then I'm getting out of that and I might lose focus. So it sounds like your thought direction has already begun to, all right, we did that $2 million one. Now I'm talking the $10 million one. Does it just keep going up in numbers? I mean, what would be the 5 or the 10-year plan, and what are you seeing yourself doing with these assets, or what direction, over the course of time? Do you follow where I'm trying to go with that?
No, absolutely. And I think I've seen that shift, as you said, pretty quick. The first property I bought was $1.4 million. It was a 48-unit deal, and it's a heavier lifting property. We bought it. It was 70% occupied. We took over on closing. About 65% of the tenants were paying, and out of that 65%, half of those tenants weren't even good tenants, and they had to go. So over the last, let's just call it 5-6 months, we've been turning that property very aggressively. I'm not going to say it's a time suck, but, it's up and down. And now from that property to my 200 unit in South Carolina, That's a $10 million deal with turnover rate lower, better quality of tenants, better quality of management. As you go bigger, you tend to get a more regional company that's just got a more chain of command. So you're not talking to the mom and pop owner. And if you don't like him, there's no one else to go to. You just have better management on your side that has better systems in place to go with the systems you have and how you like things done. They have it their way, and you could work with them and figure it out, as opposed to a mom and pop guy where you're more or less holding their hand and teaching them the way you want it done, an old dog, new tricks. But from that property to where I am now, I've already seen it. Like you said, that property I'm looking at selling in the next probably 6 to 12 months because I would have done what I had to do there. Whereas the bigger stuff, the more long-term horizon and the bigger the deal gets, I'm not going to say the easier it gets because you have the same challenges. But if you're going to have the same challenges on a 50 unit, why not have the same challenges on a 200 unit? And to think that, if you're going to have the same challenges on a 2-family, it's going to be the exact same stuff on a 200 as a 2-family, except for the manager on the 2-family is not going to be as good, or not going to be, I'm not going to say as good because that's very, I'm painting a picture negatively on those managers. It's the same challenges you have to overcome, except the dollars are bigger. All that means is you build your portfolio and what you do on the smaller ones to get into the larger deals. But you're right, to the point where I think where you were going was I like to be in that $10 to $20 million space. I'm not going to say I don't see me going bigger, but that 15 to $30 million space is a very comfortable space to be in for a professional group where you're not going to run into much institutional challenges where you're going to be competing with large institutionals, national REITs, large hedge funds. You'll deal in the more not mom and pop, but the professional guys, the owners that they run it like a business, 5-10 year hold in and out, keeping that safe, that deal size. So I would say that's really where I want to bring my business, instead of from the $5 to $20 million space, from that $10 to $30 million space, and stay in there for the long term. I think that's where I see myself going and sort of getting away from those smaller 50 to 100 unit sub $5 million deals, because I just see a better quality of manager, better quality of what you're buying in those larger, that space. I think there's a very good opportunity for investors to get into that space where you're going to sort of push away the big funds and the institutions, but you're going to be significantly better than the mom and pops and the small professionals that it's just been in their family 5, 6, 7 buildings. You're going to be better than them, and you're not going to have the competition from the institutions. Did I answer the question? Yeah,
right on point. So what type of mechanism, or describe the private money or the money raising component of your business? What drives the ability to invest? And maybe just give an example of how one of the deals was funded as far as the breakup of percentages of ownership or, distribution of profits. What percentage of the deal did you take as the manager? And just kind of give us a rundown maybe of one deal and what you have in place to raise that money.
Awesome. Yeah. So obviously, as you say, every deal is going to be a little different, but we'll just take one deal, for instance. What I normally do on the investment side, the private money side, I like to I'll take my deal out in Columbus because it's smaller numbers and they're pretty, instead of going on the much bigger numbers because the percentages don't change. My deal in Columbus is a 1.4 all-in deal with renovation, closing costs, whole 9 yards. So what I do is, the equity needed was $580,000. I'll go out and raise $580,000 from friends, family, coworkers, relationships I've developed over the years, where they'll invest in the property, and I do on that deal, I'm doing an 80-20 split. So for every dollar that comes out for an investor, they get 80 cents, I get 20 cents, and it's based on the pro rata share that they have. So for instance, if I have a $500,000 raise and the guy gives $250,000, and then I have 2 guys giving $125,000, that $250,000 investor is a 50% owner in the deal, but I'm on an 80-20 split with him. So forget the 50% ownership. The dollars that come out don't differ. He just gets a larger percentage of the dollars that come out. And then in that 80-20, there's a performance clause. So if I hit a certain return, that split goes 80-20 down to 60-40 over that bump. So if I'm giving investors 10% And then I say at 12%, it's going to go 60-40. The first 12%, still 80-20. The 13% and higher, that's the only dollars that gets distributed 60-40. So it doesn't impact the investor's return. It's not like if I hit that, the whole thing gets split. It's only on the portion over the hurdle. And then I get a management fee and then the acquisition fee for putting the deal together up front. So the acquisition fee up front is generally between 1% and 5%, depending on the size of the deal and the listing of the deal. If it's a big value-add renovation, there's more involved. I get more. If there's less involved, smaller. And then the day-to-day management, managing the managers, managing the investors, getting the paperwork together and all the filing and all that, I get an asset management fee, and that's generally about 1% to 2% of the gross collected rent. And then on sale, there's different ways to do it on that deal. I have an 80-20 split on sale as well. So you get a fee up front, an asset management fee, portion of cash flow, and a portion of the sale. That's the four ways that I get paid on a upfront, day-to-day, and back-end number. That answer the question?
Sure does. Now, what about recourse signing for loans? Are these investors who put $250,000, $400,000, $580,000, are they also signing personally to guarantee that loan, or is that something that you handle, or are there non-recourse loans available in the market?
Absolutely, great question. The larger deals, when you try and get like a Fannie or Freddie product, a Fannie Mae or Freddie Mac loan product, even not just them yet, there are non-recourse options, which is what I look for right out of the box. Something that is non-recourse, you mess up the deal. As long as you didn't do anything illegal, you hand back the keys, you lose your investment. That's obviously the best case because then they can't come and get you for the money. But back to my favorite question in real estate, it depends on the deal. My deal down in South Carolina, my 200 unit, my partner and only investor in that deal is 100% comfortable with a recourse loan because he understands the risks and we might be able to get a better rate. Now we are ending up with a non-recourse loan, but he's helping me out on the balance sheet and signing the loan with me because I don't have $10 million net worth to make that loan possible. He does. So we're working together. He's an investor part. My investors are partners in the deal. They are equity owners. So I'll refer to them as partners, not investors. There are some guys that are 100% passive and there are guys that, want to have a little bit more of an active role. They tend to put in a little bit more money. But back to the loan question, yes, if it is a recourse loan, I take one, the sponsor side of the deal. So there's the operational and the sponsor side of the deal, the operating LLC and then the sponsor side. Everything is run through that. So everyone over, depending on the bank, but about 25% equity ownership has to come up with a financial balance sheet or, proof of funds for the bank. Everyone less than that, they generally don't have to show any income or tax returns or anything like that. Anything more than 25, they do want to see it, but I take as much as I can, and then if I have to bring on a partner for a balance sheet to help me out, I cut them in on my side of the deal. It doesn't impact the investors. I take it out of my pocket. So I think that answers the question, right?
Yes, sir. So this is pretty generous to give 80% on that deal. Can we get, and I know the deal's not done or closed yet, but just pro forma numbers. If somebody were to put the whole $580,000 into that deal all at once, what would be their anticipated preferred return or what you had pro forma that they would be getting monthly, and what would be like the out sale on the deal like this, looking at it from day one?
So day one, the way that I structured that deal, because it is a value-add deal, so in the beginning there's not much of a return because all the money is going back into the deal, and that's renovations, money coming out for improvements, whole 9 yards. That deal is pro forma'd out to be about a 13% annualized return on sale. What I did with investors in there is I basically told them, I will give you 10%. It's not preferred because I'm not giving them it before I get paid because there is a lot of listing in the deal. I basically said on sale, annualize out at least 10% before, so I'll give you 7-year one and then 8-year two. On sale, I will backfill those years to get to 10 before anything else happens, before there's a 60-40 split or anything like that. So that deal is pro forma'd out. It's pro forma'd out to return about 17% if we hit all our numbers, and we are doing very well on that deal. I mean, we're at our year 3 rents in 6 months of ownership, but the investors are looking for a 13% return. That's the number I went out there with and told them, this is what we're trying to accomplish. this is what we're going to hit. Whereas if IRR and cash on cash are two big numbers I use, I know if I could hit my numbers sooner, my IRR goes up. And what we're looking at right now is probably about a 17% return on that deal. And then, as like I said, every deal is a little bit different, but to give deal number metrics, generally 8% cash on cash is the bottom line number that I look for. About between 8 and 12% is what, they're more or less coming out with. That's sort of the numbers that I look for in the deal structure. But a guy like that, if you wrote a $580,000 check on an 80-20 split, would probably be looking at about a 13 to 17% return on that deal.
Interesting. And when it comes time to do these splits and this dividing of the income, I mean, do you just have an assistant or a bookkeeper figuring these things out, or do you have to sit down, handwrite a letter to each investor as part of your investor relations to keep things cooking? I mean, how does that distribution work? Monthly?
Yeah, so every deal, once again, people get sick and tired of that, but deal by deal, some deals are quarterly distribution, some deals are semi-annual, some deals are monthly. My deal in South Carolina is one investor. It's going to be a monthly distribution because it's just him. It's very simple bookkeeping. On the bookkeeping side, part of my sponsor role is to just make sure everything looks aligned, but I also get everything over to my accountant. They are full, on each deal. They are part of the underwriting. Their fee, I know what it is. Each, depending on size, but they handle everything. That's why I don't generally do monthly distributions or even quarterly, because if I have 10 investors in a deal or 15 investors in a deal, it's difficult to have my accountant. He doesn't get paid enough, to be honest, for him to write out checks on a monthly basis. I'll write the custom letter to each investor with the check to say, hey, here's your distribution, but he has to put it all together. He does all the K-1s and all the taxes and he does all the back end side of that to keep it nice. And then, yes, there is an assistant who happens to be my girlfriend who likes to do the more or less day-to-day stuff. She doesn't split it up, the accountant does, but she does the back-end work on the investor relations stuff, sort of behind the scenes to keep everything aligned on that front. So, no, the answer is I'm not doing it all. I do have an accountant to handle all that and, back office to handle the, making sure everything gets out and does what it's supposed to do.
Got it. And is that a cost or an expense to the deal, or does that come out of your 20%?
That is in the underwriting of the deal, so I factor that into the deal. It's a deal expense, but it's factored in. It's part of the underwriting, so it doesn't come out of my pocket. It does, it's part. The deal has to support that. If the deal doesn't support that, I don't do the deal, because I'm not saying that I shouldn't pay for it, and I'm not saying the investor should pay for it. I'm saying we're not going to buy the deal if the deal can't pay for it with you still getting your return. On the flip side, there's a lot of stuff that, my acquisition fee, whether it's 1 or 5%, I'm not saying I write it all off, but I do take care of a lot of things because me personally, I think there's some things that the deal could support, but that's not the deal's problem. If I can make the deal work better and give more money to my investors, that's fine with me because, they're allowing me to take my business from where it is to where it's going. And, if that costs me a couple bucks, I'm more than prepared to do it. So, if the deal, it gets a little off the hinges and I got to get it back on track, I don't mind taking the stuff out of my pocket, taking it out of my 20%, because if something hurts the deal and the investor could do better, yes, I don't mind taking that out of my side because, to be honest, most of my deals, I don't have much money into the deal anyway. I'll put up the earnest money or I'll invest a little bit. But as my business has grown, I've come across the investors that don't require as much of my money in the deal. I do like to get some money into my deals just to show skin in the game. But for their health and everything they've done for me, I don't mind taking care of them if I have to. But the deal has to make sense. The deal has to support it first and foremost, and then we can always tweak it any way possible.
So, John, we've enjoyed a historic run of low interest rates over the past, 10 years plus. On the flip side of that does some things to the debt service income ratio and allows you to buy more property and therefore translates into lower cap rates and higher values in the apartment sector. Can you give me your take on the interest rate raising risk and what you're planning to do for that, or looking forward, how that's going to be handled for you?
I think that is it's something that comes up every day, and I have both sides of the story. I have people saying, don't worry, we're good. They can't go up that much. And then I have other investors and myself and people saying, it's something to think about. So to hedge myself against that, because what's happened over the last X amount of years has been great. You're right. Debt service coverage ratios are great. Cap rates are at an old, they are so low because people can borrow more money at a lower number. So my hedge to that is I've sort of taken two deals or deal models or deal acquisition criteria that I look for. One, because interest rates are low, I like to put a little bit more equity down on my deals just in case interest rates go, they do spike. On a long-term horizon, one thing that no one can take away from you is your equity in a property. So to hedge, I like to put a little bit more equity down for long-term security on my deals. And I'm not talking about, 5% down to, 50% down. I'm in the 20 to 30% range. Closer to 30 is a very secure number in my eyes. Also, I've stopped looking at the completely vacant buildings that need, $20,000 a unit of renovation, because if you do short-term bridge debt or, a higher interest rate loan, if that deal does support a refinance 2 years down the road, 24 months down the road, if interest rates are significantly higher, and that might be 1 point, that might be 2 points, that might be a quarter point. We don't know. To hedge against that, I've sort of taken the heavy lifting deals, and I haven't tabled them, but I have to be 100% certain of what I can deliver. So when I refinance, I can pull out the money I need. I can get the investors back. I can get the bridge debt paid off, so I don't have to, juggle a million balls on a refinance. So I've sort of tabled the super heavy lifting deals, and I sort of shift my focus to a little bit more equity, more exterior improvements, adding amenity space, new management, fresh blood, something like that, or proof of concept and renovations, something that's a little bit less risky to a degree. And I use that word loosely because, what's less risky? That's going to be in any investor's eyes. But for me, to hedge against the inflation question, that's part of why I've shifted my focus onto a little bit of a better value add deal as opposed to just a complete reposition where you're just doing something completely crazy and you're trying to pigeonhole yourself into a return. I like to be a little bit more conservative on that front. I think that answers the question, right?
Is there a deal blowout clause where you're allowed to decide, hey, this hold period is no longer 60 months. We have to refinance. We have to keep this. Do you have decision-making capability in there to make that, on behalf of investors?
Yeah, so generally when I pro forma out and I put together an executive summary, I generally either do it on a 5 or 7 year basis. I'm not saying that I don't want to hold deals for 10 years, but I would be completely crazy, and I think anyone would agree. For me to predict the future in 10 years it's 100% speculation. No matter how smart I am, no matter what my background is, nobody knows what's going to happen in 10 years. Most of the time, people don't even know what's going to happen in 5 years. So I pro forma out 5 or 7 years, but in each operating agreement, private placement document, in that it says, also up to the sponsor. So if we hit our year 5 numbers in year 2, I'm going to sell. And I have 100% control on the day-to-day stuff like that. So yes, in each deal, I have the option, and on the flip side, if we're not hitting our numbers, I can make the decision to refinance and keep in there and stay like that. And that's one of the risks the investors take is I'm wrapping my money up and it's all contingent upon the deal. So that's something I sit down with investors, and before we get involved, I make sure that what they're putting in is not their life savings, because if they need that money and it's in that deal, they're either going to take a pretty big loss when they have to sell out to somebody on a fire sale, or I want to make sure they're protected and they're comfortable doing, I want to make sure they're okay and comfortable before they come on board with me for their protection. But yes, the answer to the question is good or bad, I have the decision-making capability to keep it or to not keep it.
Cool. And one of the things you mentioned to me before the call was the real estate financial planning. Can you elaborate on that and talk about what that means for people listening?
Yeah, no, that one thing that I sort of take into in my business is how you could use real estate as a tool for your financial future, and whether that's an investment in me or whether that's an investment in a REIT or whether that's an investment with somebody else. Sitting back and looking at the portfolio as a whole, that's coming from my financial background. By basically saying, listen, you have $1 million. Why do you have $900,000 in stocks? Well, I'm a really risky person. Okay, that's great. I'm not saying stocks are bad. I don't say bonds are bad. I don't say mutual funds are bad. I think that diversification is huge. Whether that's an insurance product, a life policy, or whatever it may be, sitting down with people and looking at their portfolio on a whole and how we can utilize it. There are so many people I sit down with like, oh, yeah, I got this rental property and wherever, and it's 100% paid off. And I'm like, well, that money is not earning you anything. You know, it's vacant right now, or you're getting $400 a month in rent and it's paid, you know, maybe you could use that as a little bit of leverage. Maybe you sell that and you can get a better return in a different deal. So one thing I like to do, and this starts off with the first question of, you know, where do you see yourself in 10 years? What are you looking to accomplish? Because if we can look at their portfolio as a whole and get them to a place that they want to go, whether it's using real estate or, you know what, you're set up perfectly. You have everything in order. It's something I like to do for my investors as more or less a consultation free. Listen, I think that I could add this value to your portfolio and build it. Or it could be future planning. Basically, I have a kid that's 3 and I want their college paid off in 10 years, 15 years, or I want a building to supplement the, you know, the college payment. Well, let's look at that option. Let's see if we can go find a building or go find a property or find an investment on the real estate side that will not only give their kid or them a tangible, physical, hard asset that's theirs, but it also could supplement an income or offset an income or allow people to say, you know what, I want to retire, but I need this as a side. I need to make money over the next 10 years. And that could be starting with a 5-unit building, a 2-unit, you know, whatever it is. We can look back and say, okay, this is how we have to grow. We have to buy a 50 unit that produces this, you know, pay down, sell off, and then we have to get to that. So that's what I like to do on the real estate financial planning side is how could real estate help out your portfolio and what it could do that you maybe you didn't think existed. How can we add that to what you're already doing as an investor?
So, John, this is something that you would offer to somebody who had a portfolio and you would sit down and have this conversation. This is kind of what you can provide. If somebody was listening, should they reach out to you and your company if this sounds like they should have this conversation with you?
Absolutely. It's something that, you know, it's completely complimentary. I'm not going to charge you. It's basically, let's take a look at it globally. Let's sit down and see what's not being used properly, where you could find more equity, because a lot of people want to invest in real estate. It's like, I don't have enough money. It's like, well, you do. You know, you have an old 401k and, you know, you have an IRA. You can use that stuff and those tools. So it's something that I love to sit down with people. It could be an hour. It could be 4 hours. It could be through Skype. It could be in person. Whatever the person feels comfortable. It's definitely an intimate time where, you know, you're going to have to be honest. But if anyone's interested in it, that's actually something they can contact me. Because, you know, they're going to have to tell me, you know, you can't tell me you got $1 million liquid and then you show me your stuff and it's like you got $2,000 in your account, because that's not going to help you. You know, I don't mind it, but it's definitely, if someone wants to get that input and see how that's going to go, please. That's an absolute thing that I offer to everybody to show them, you know, potentially on where it could go.
Cool. We're getting close to the top of the hour here. Do you have 3 book recommendations for our listeners, John?
Sure. I think great business book, Think and Grow Rich. It's not the easiest read. I'll be the first to say that. I'm not the smartest guy in the world. But I just think it's a great book. I think it's something on a business side, a philosophy type book. I love it. The Millionaire Real Estate Investor, I think, is a very easy read, the complete opposite of Think and Grow Rich. The Millionaire Real Estate Investor shows, you know, it's a very general picture of what you want to start to do if you want to become an investor and how you want to set up a business. And then I like the E-Myth. I think it's another good book. Those are probably the top 3 on the real estate business side that I think would make a lot of sense for, you know, investors of all walks of life, super experienced to people that are just starting out.
So Think and Grow Rich by Napoleon Hill, Millionaire Real Estate Investor, that's by Gary Keller, correct?
Yes.
And E-Myth, which is E-Myth, there's several out there by Michael Gerber. And it's ironic that you say that because every expert guest I've had on the show who is managing a large number of units, as in 100 doors or more, is swearing and living by the E-Myth. So everybody that I know with large amounts of deals has read E-Myth, either E-Myth Mastery, E-Myth Revisited. The basic concepts there definitely translate over into being able to scale up the number of tenants and therefore rental properties that an investor could own. So those are 3 great oft-mentioned books on our show here. And my last content question here for you, John, is do you have any final jewels of wisdom to share with our listeners?
Yeah, I would say the best thing, and it's advice that I've heard from a lot of people, I'm a big believer in done is better than perfect when it comes to real estate investing. If you want to be perfect, you could always second guess anything you're going to do, whether it's a post on Facebook, whether it's an email to your database. You could always delete it and say, I got to redo it, it's not perfect, and you'll never get it done. It's analysis by paralysis to a degree, whereas put yourself out there, get uncomfortable, send it out, put yourself out there, put yourself on the chopping block sometimes, get up, speak in front of people, and just do it. If you get it done and you learn from, I could have done this better, that's significantly better than trying to be perfect and running the perfect operation out of the box. I think any successful person, and I'm not saying I'm successful by all means, there are people that are significantly better, they failed a lot. They didn't just come out of the box and wake up and have the perfect idea without failing. And I think it's because they put themselves out there and they made some mistakes. Just learn. Don't, you keep making the same mistake over and over. We all know what that is. But learn from the mistakes, get out there, just do it, and put the right team around you. If you're talking to your parents, your friends, your database, and your network, and they're all telling you that you're going to fail, you're never going to do this, real estate's never going to work, you and everybody else, there's a million shows on TV about fixing houses, those aren't the people that listen, you love your family, you love your friends, but get the right team around you, get the right support staff. That is an invaluable resource to put the right people around you. And I'm not telling people to go out and seek a high net worth coach, but find the group that's going to support your decisions and help you get to where you want to go. They're out there, they exist, and there are great tools in those support groups, whether it's an attorney, an accountant, they'll all refer the right people. And I think building a good team is absolutely huge, and just get it done. Don't think of the excuses. Wake up, do what you got to do, say you're going to do it, and do it. Those are probably the two biggest things I could tell people getting started, and don't be scared. Nice.
Yeah, I think you touched on quite a few there. I know that dovetails with the, tell me your 5 friends and tell me the income of your 5 friends, and I'll tell you your income within certainly even the bank balance within a small percentage of error. And I remember, my 5 friends didn't have much of that, or the people I was spending the five people I spent the most time with, years ago. And now it's a different collection of people that I'm spending the time with. And sure enough, we're all, earning somewhere near the same amount of money. We're all doing somewhere near the same amount of activities. We all, hit the gym on a regular basis. It's like you eat birds of a feather. So identify if you're not happy with the feathers, if you're not happy with where you're at, identify the other people you want to be like and see if you can get around them and add value.
Absolutely. I think that added, that touched on my point to a better degree. Bottom line, if you bring value to any situation, it's worth some. It could be worth $1 million. It could be worth bringing value to your group. And I think that you touched on it perfectly. Surround yourself with the people you want to be and keep moving up if that's where you want to go. And if you're happy with what you're doing, nobody's going to tell you that you should that you're not making enough money. But put yourself in the company, in the situation of where you want to be. And you're right. And that's exactly what you want to do, especially real estate. Because real estate, it's something that I started saying recently. No investor is perfect. No deal runs 100% smooth. We all know that. But the investors that are successful and the investors that aren't successful, they have the database, the network, the people in their phone book to fix a problem when it need be. So they have the person they can call to right the ship. So, getting out there networking with the right people and everybody is going to give you more people to call in case of a problem. And that will automatically make your deals run smoother when you have the right people around you. So I couldn't agree more with what you just said.
John, how can our listeners get more information about you?
So my website is jcpropertygroupinc.com. On there, you'll find a little bit about, it's still a work in progress. I actually just rebranded everything. Literally last night at 10:30, the guy that's doing my website sent me the new version. That'll probably be published live in the next 15 to 30 days. On there's my contact information, but my office line is 516-268-3500, extension 101. And then my email address, johnc@jcpropertygroupinc.com. Those are the two best methods of contact. I'm pretty easy to reach, and generally with about a little bit of advance notice, I could arrange my schedule pretty easily to get a conversation in to, give someone an hour of my time, if they want to pick my brain. Those are 3 great contact tools for me. And then obviously reaching out to Dan, he has my contact information. If you miss that, I'm sure I don't mind. You could pass it along. And all right. That's about it.
Well, cool. John, thank you for coming on the show. I got a couple pages of notes here, plenty of insight into your rapid fire success here since 2010 getting into the business. Thanks for coming on the show.
I appreciate it. No, I appreciate you having me on. It was, it was awesome. If you ever need if you ever have some more questions, you want to do another show, I'm always available. I like to put myself out there. I definitely like to put myself out there. So I appreciate you having me, and I had a great time.
Cool. And to you, my loyal listeners, thank you for continuing to tune in to the REI Diamond Show. Do you know anybody else who would also enjoy this episode? Send them a link. You can sign up to receive new episode notifications at www.reidiamonds.com. And as a bonus for signing up, I'll also send you my special report titled 7 Sources of Off-Market Deals. There is also a public relations link on that page for those interested in applying to come on the show as an expert guest. That website again is www.reidiamonds.com. Thanks again for listening. Dan Breslin here. I'll catch you next time. And remember, here at the REI Diamond Show, we're dedicated to increasing, multiplying, and protecting your net worth.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.